You've seen this before, right? A business that seems to be absolutely crushing it. They're hiring, they're expanding, sales are just rocketing upwards, but something feels off. Behind the scenes, they're actually closer to disaster than ever before. It's a really scary and confusing situation. So today, we're going to unravel this exact puzzle. How can a company that looks profitable on paper be secretly running out of cash? Well, the answer starts with a lesson from someone who knows a thing or two about growth.
And hey, this isn't just a problem for the little guy. That quote, that's from Michael Dell. He frames the issue perfectly. Think about it. Your profit and loss statement, that's like the speedometer in your car. It tells you how fast you're going, which feels great. But cash flow, that's your fuel gauge. And if you're only staring at the speedometer, you could be flying down the highway feeling like a success, right up until the engine sputters and you coast to a dead stop.
So, this brings us to this really strange idea, the profitable bankruptcy paradox. It just seems impossible, doesn't it? I mean, if you're profitable, you're winning. How could you possibly fail? Well, the answer is all about the gap between what your accountant calls profit and what's actually physically in your bank account.
Okay, so here is the secret to the whole paradox. On one hand, you have accrual accounting. It's how most businesses do their books. It basically says you've made a profit the second you send out an invoice. But on the other hand, you have cash flow. And that's the real stuff. The actual money coming in and going out. You can have $1 million in profitable sales on paper, but if none of your customers have paid you yet, you have zero cash. And let's be real, you can't pay your bills with promises.
And this leads us to the hidden trap that trips up so many companies. It's a blind spot, and the faster you grow, the bigger and more dangerous this blind spot gets. Growth itself, the very thing you're chasing, can become this quiet, hungry beast that eats up all your cash.
I love this way of putting it, from the Yale School of Management. They don't just call working capital some boring financial metric. They call it blood and oxygen. Because that's exactly what it is. It's the thing keeping the whole operation alive, day in and day out. And if you run out of it, it doesn't matter how great your product is, how amazing your team is, or how high your profits are. The business dies.
So what is this working capital, really? Well, put simply, it's the money that gets trapped inside your business. Think about the timeline. You have to pay your suppliers for raw materials. You have to pay your employees every 2 weeks. But you might not get paid by your customers for 30, 60, even 90 days. Working capital is the cash you have to have just to survive that gap. And this is exactly where the trap is set. The math is simple, but what it means is huge. As you sell more, your assets go up. Things like inventory you need to buy and accounts receivable, which is just money your customers owe you. Now that looks fantastic on a spreadsheet, but both of those things lock up your cash. You paid for the inventory, but it's still sitting on a shelf. You made the sale, but you haven't been paid yet. The result is just wild. More sales can actually mean you have less cash on hand.
It all boils down to the timeline of your money. It's not just about how much money is coming in, it's about when it's coming in. Timing is absolutely everything. And when a business is growing fast, that timeline can get stretched thinner and thinner until it just snaps.
And there's actually a name for this timeline. It's called the cash conversion cycle, or CCC for short. You can think of it like a stopwatch for your money. It measures in days how long it takes from the moment you spend $1 to the moment you get that dollar back from a sale. It's literally how long your cash is held hostage by your own business.
Okay, so let's just trace the journey here. First, a business buys inventory. Then it has to pay its suppliers for that inventory. Sometime later, it sells the product. And then finally, way down the road, it collects the cash from its customers. That entire timeline, from cash going out to cash coming back in, that's your cash conversion cycle. And every single day in that cycle is a day your money is gone. The longer that cycle is, the more cash you need just to keep the lights on, never mind trying to grow. So here's the bottom line. Working capital basically puts a price tag on your growth. If you can keep that price tag low, get paid faster by customers, maybe pay suppliers a little slower, growth is cheap. You can fund it yourself. But if that price tag is high, growth becomes incredibly expensive because every single new sale demands a bigger investment of cash that you just don't have.
Now let's zoom out a bit. This isn't just some theoretical problem for one company. We've seen this play out on a global scale. During the COVID-19 crisis, there was this massive decoupling of a company's actual health from its ability to survive, and that created the fragile environment a lot of businesses are in today.
This chart here, it tells a pretty wild story. Just look at the red line, which represents the COVID crisis. It shows something totally backwards from what you'd expect. The more money a company was losing, the more debt it was able to take on. Now compare that to the blue line from the global financial crisis, where struggling companies just got cut off from credit.
This easy debt created what's called a bankruptcy gap. Companies were kept alive by loans, not by their own cash flow. And, well, what happens then? That flood of easy credit, it worked as a short-term patch. It definitely stopped a huge wave of bankruptcies, but it didn't fix the real problem. It just kicked the can down the road, leaving behind a mountain of debt and making the whole system a lot more fragile.
So, all of this brings us back to one simple survival imperative. Of course, growth is the goal, but growth without a ruthless, disciplined focus on cash flow doesn't lead to success. It actually accelerates failure. It's like flooring the accelerator when you're already headed for a cliff.
And in the end, this quote just nails it. You can have the slickest product, the fastest growth, the most impressive profit and loss statement in your industry, but those are just stories. The reality is written by the number in your bank account. Because in business, no matter what, cash is still king.
Independent analysis prepared by SimplifyNumbers.com.